Hey everyone, and welcome back to the channel. Today we're diving into a timeless classic for anyone serious about investing, How to Pick Stocks, by the legendary Fred W Frailey. Now you might be thinking, another stock-picking book? But trust me, this one is different. Frailey wasn't just a writer. He was a deep thinker who spent decades figuring out what really makes a great company and therefore a great stock. His wisdom is just as relevant today, if not more so, in our fast-paced market. So, if you're tired of chasing hot tips and want to build a solid long-term investment strategy, you're in the right place. We're going to break down Frailey's core principles into actionable steps that you can start using right away. First up, let's talk about Frailey's golden rule. Invest in businesses, not tickers. This sounds simple, right? But it's a profound shift in mindset. Many people see stocks as just flickering numbers on a screen, something to buy low and sell high. Frailey argues that this is just speculation, not investing. True investing is about becoming a part owner of a real, living, breathing business. Before you even think about hitting that buy button, you should be able to answer a fundamental question. What does this company actually do? How do they make money? Who are their customers? What makes them special? Imagine you were buying the entire company, not just a few shares. Would you be confident in its future? This mindset forces you to do your homework and understand the underlying value of what you're buying. It's the difference between gambling on a stock symbol and partnering with a successful enterprise. This is the foundation of everything else we're going to discuss. Building on that, Frailey was a huge advocate for what he called durable competitive advantages, a concept famously championed by Warren Buffett as an economic moat. Think of it like a castle. A great business has a protective moat around it that keeps competitors at bay. What does this moat look like in the real world? It could be a powerful brand name that everyone knows and trusts, like Coca-Cola or Apple. It could be a patent that gives a company exclusive rights to a technology, like a pharmaceutical company with a blockbuster drug. It could be a network effect, where the service becomes more valuable as more people use it. Think about social media platforms like Facebook or professional networks like LinkedIn. Or it could be a cost advantage, where a company like Walmart or Amazon can offer prices so low that smaller competitors simply can't keep up. When you're researching a company, your job as an investor is to identify this moat. Is it wide and deep? Is it sustainable? A company without a durable competitive advantage is vulnerable. A company with one can fend off competition and generate consistent profits for years to come. Next, let's get into the numbers. Frailey wasn't just about the story. He insisted on a deep dive into a company's financial health. But don't worry. You don't need a PhD in accounting. He focused on a few key metrics that tell a powerful story. First, look for consistent and growing earnings per share, or EPS. This shows that the company is becoming more profitable over time for each share you own. But don't stop there. Look at the return on equity, or ROE. This metric tells you how effectively the management is using shareholders' money to generate profits. A consistently high ROE, say above 15%, is often a sign of a well-run company with a strong competitive advantage. Another critical area is debt. Frailey was wary of companies loaded with debt. A little bit of debt can be a useful tool for growth, but too much can be a massive risk, especially when the economy takes a downturn. Look at the debt-to-equity ratio. A low number here means the company is financed more by its own money than by borrowing, which is a much safer position to be in. These numbers aren't just abstract figures. They are the vital signs of the business. One of the most important and often overlooked aspects of Frailey's philosophy is the quality of management. As he would say, you're not just buying a business, you're entrusting your capital to the people running it. So how do you judge a management team from the outside? Start by reading the annual reports, specifically the CEO's letter to shareholders. Is the CEO honest and transparent about both successes and failures? Or do they just gloss over problems with corporate jargon? A great leader takes ownership. Look at their track record. Have they allocated capital wisely in the past? Have they made smart acquisitions, or have they overpaid for flashy deals that destroyed value? Also, check to see if management has skin in the game. Do the executives own a significant amount of the company's stock themselves? When their own financial success is tied directly to the company's performance, their interests are much more likely to be aligned with yours as a shareholder. A brilliant business can be run into the ground by poor management, while a great management team can navigate a good business through any storm. Now, let's put it all together with the final piece of the puzzle: valuation. Finding a wonderful business is only half the battle. As Frailey emphasized, you have to buy it at a reasonable price. The greatest company in the world can be a terrible investment if you overpay for it. So, how do you determine a fair price? A simple and effective tool is the price-to-earnings, or PE ratio. This compares the company's stock price to its annual earnings per share. You can compare a company's current PE ratio to its own historical average and to its competitors. A PE ratio that's significantly lower than its peers or its history might signal a potential bargain. However, be careful. A low PE can also be a value trap, a sign that the company is in trouble. That's why you must use this in combination with everything else we've talked about: the business quality, the competitive moat, and the financial health. The goal isn't just to find cheap stocks. It's to find great businesses trading at fair, or even better, discounted prices. It's about paying a fair price for a wonderful company, not a wonderful price for a fair company. So, to recap Frailey's timeless wisdom. First, think like a business owner, not a speculator. Understand what the company does and how it makes money. Second, identify a durable competitive advantage, that economic moat that protects it from competition. Third, analyze the key financial metrics. Look for consistent earnings growth, high return on equity, and low levels of debt. Fourth, evaluate the quality and integrity of the management team. Are they shareholder-friendly, and do they have skin in the game? And finally, be patient and wait for a reasonable price. Don't chase hype. Buy wonderful businesses when they are on sale. This isn't a get-rich-quick scheme. It's a disciplined, thoughtful approach to building long-term wealth. It requires patience, diligence, and a commitment to continuous learning. But by following these principles, you move away from the noise of the market and focus on what truly matters: the underlying quality of the businesses you own. This framework from Fred Frailey gives you a powerful lens through which to view the stock market. It transforms investing from a game of chance into a strategic endeavor. It empowers you to make your own informed decisions, rather than relying on the hot tip of the day. The next time you're considering an investment, run it through this checklist. Does it pass the Frailey test? If you take the time to do this research, you'll not only become a better investor, but you'll also sleep a lot better at night, knowing your hard-earned money is invested in solid, durable, well-managed companies. That's the real secret to long-term success in the market. Thank you so much for sticking with me through this deep dive into Fred Frailey's philosophy. I hope you found it as valuable as I have over the years. If you enjoyed this video and want more content that breaks down timeless investing wisdom, please give this video a thumbs up. And more importantly, hit that subscribe button and ring the bell so you don't miss our next one. I'd love to hear your thoughts in the comments below. What's the most important factor for you when picking a stock? Thanks again for watching, and I'll see you in the next video.